Hello and welcome to another production brought to you by the Accounting Maestro. In this tutorial, we discuss an important accounting concept, the revenue recognition principle. Before we do so, however, we need to ask ourselves, what is revenue? Consider an example. Suppose you are the owner of PK Limited, a company specializing in the sale of electrical goods. On the 24th of August, you sell $5,000 of goods to a customer. You receive $5,000 cash in return. By selling those goods, your company has generated a revenue. We record the earning of this revenue as follows. We debit cash for $5,000 to reflect the increase in an asset, and we credit sales revenue for $5,000 to reflect the increase in equity. Hence, we define a revenue as an increase in resources resulting from the sale of goods or the provision of services. As we will discover, however, the recording of a revenue does not have to involve the receipt of cash. The revenue recognition principle states that a revenue should be recorded when a resource has been earned, and not just when cash is received. Given this definition, let's consider an example. Suppose on the 11th of December, Daffy & Co. purchased $10,000 worth of electrical goods for a new accounting firm. The goods are purchased on account. Now, because the goods have been purchased on account, PK Limited now has a receivable from the customer, an asset. So we debit accounts receivable for $10,000. But because PK Limited has provided the goods, it has earned revenue. We call this an accrued revenue, and we credit sales revenue for $10,000. Now, if PK Limited receives payment a week later, we would simply record the following. We would debit cash for $10,000 and credit accounts receivable. Note, however, that the revenue accounts are not affected here. Revenue was earned in the previous transaction. All we are doing here is exchanging one asset for another. Now suppose that Mr. Donald, the owner of Daffy & Co., wants these goods delivered. PK Limited charges a $15 prepaid delivery fee. Daffy & Co. pays this fee upon purchase. Using the date of our original transaction, we debit cash for $15 and we credit unearned service revenue for $15. Because PK Limited, however, has not yet provided the promised service, it cannot record a revenue in its account system. Instead, the company now has an obligation to deliver the goods, increasing a liability account called unearned service revenue. When PK Limited carries out the delivery service 3 days later, it will have earned a revenue. We debit unearned service revenue for $15 to reflect a decrease in a liability, and we credit service revenue for $15 to reflect an increase in equity. So in conclusion, under the accrual basis of accounting, revenues are recorded when they are earned. This is the revenue recognition principle.